Monday Morning Matters. Perspectives from Southeast Asia.
Hey, this is Arlene. We are back again with our Monday Morning Matters. Every Monday, we will talk about a topic related to ASEAN. So today we are going to talk about the oil prices. As we all know, the oil price is falling really fast, and it's affecting the global economy, and especially it's affecting the world's superpowers such as Russia. But in Southeast Asia, Malaysia is one of the only net oil exporter in the region. Its oil imports have risen relative to oil exports over the last 3 years, especially with declining in terms of Malaysia's government's oil revenue. It will affect in terms of the fiscal deficit of this country. And also, when it comes to the future of Malaysia being the chair country of ASEAN Summit this year, would it really affect in terms of how it will affect the economy, the ASEAN economic community in this region? It is left to be seen. But just a bit of background with how the falling price of crude oil continues to put pressure in Malaysia especially. It has been putting pressure in terms of our economy and also in terms of our ringgit value at 3.4975 ringgit against $1. The local currency is already the worst performer in the ASEAN region this year. A protracted decline in oil prices will in fact limit its upside potential. A 5-year low in crude oil prices could reignite concerns about the government's budget balance and trade balance, which will add downwards pressure to ringgit and economic growth. Malaysia is definitely not looking a very good economic outlook for 2015. It is said that the price of crude oil to recover from its recent lows and average between $75 to $80 a barrel in 2015, at least 22% lower than the average price of $103 a barrel last year. And the lower oil price assumption could slash Malaysia's real GDP growth by around 0.6% to its full-year growth potential forecast of 5% in 2015 this year. In fact, among the worst hit from the foreign-led sell-off was Sapura Kencana Petroleum, the country's biggest oil and gas company in terms of order book. The stock, which have a higher foreign shareholder, at least 20% in January, has tumbled 47% over the past 6 months to 2 ringgit and 33%. A lot of numbering here to make sense of how the oil prices have really affected some of the key oil and gas companies in this country. And talking about oil is definitely a global, not just commodity, but a global foreign policy for any country. Countries that usually have oils, they either prosper or they are either being in ruins because of how much power interests are invested in terms of the global oil prices and global oil distribution. So why ASEAN can actually dismiss the oil plunge from affecting ASEAN itself? So there's this one news saying that ASEAN bond buyers can actually dismiss the oil plunge. The lack of oil has turned into a mark of a winner in the developing world's bond market. So, in fact, the lower the cost of the oil is actually a good thing for ASEAN. Dollar-dominated notes from the region, a net and energy importer, Malaysia has the biggest return in terms of emerging market this year with 7.49% advance. The world's fastest growing continent also held up better in December, which is of course ASEAN, when the sell-off in crude oil upturned issues from commodity producing companies in Russia and Brazil. Rising ASEAN debt demand helped push dollar issuance to a record 197 billion this year, more than the Latin America, Eastern Europe, the Middle East and Africa combined, as borrowing costs close to record lows per investment. The best region by a long shot in Asia. That was what being said by Jonathan Lemko on ASEAN. He is a fixed income money manager in the US, which oversees about 3 trillion of investment. The biggest divergence is whether you sell oil or commodities or not. And countries in Asia are more fiscally prudent than other parts of the world. Growth certainly in China, Indonesia, the Philippines is better, in fact, with the low oil costs or oil prices. In 2014, ASEAN corporate dollar bond returns have been led by companies including Indonesia Electricity Distributor PT Perusahaan Listrik Negara notes that whose notes due 2042 are up to 25%, and developer China Overseas Land Investment, who 2042 bonds gained 10.2% this half year alone. So it shows, these are examples where the low oil prices actually has somehow benefited a lot of the ASEAN bonds buyer. In which case, ASEAN has benefited the low levels of volatile, is enjoying a safe haven status as investor, shun other regions, looking at ASEAN as the primer place to invest. For Malaysia, it's a different topic. As we all know how Malaysia, even though it will be the chair of ASEAN Summit this year, with the plunging ringgit and the plunging revenue for Petronas and as our national oil company, Malaysia is not seeking a good economic outlook in this nation. But according to Bank Negara Governor Tan Sri Dr. Zeti Akhtar Aziz, she actually is quite optimistic. In fact, she said that the current level of oil prices is favorable to Malaysia's economy, as in fact what she's seeing is bringing down the cost of businesses and consumer as well as less inflationary. That's true, it's less inflationary. But bringing down the cost of businesses and consumer, that is somehow debatable. Yes, the price of petrol has gone down to 1 ringgit and 90 cent for a liter, but for a liter for around 95. But does it really bring down the cost other than the petrol cost significantly? That is left to be seen. But she's quite optimistic, saying that the region of Southeast Asia are able to remain on a sustainable growth path. She said in a special talk on ASEAN Economic Community and Globalization organized by the ASEAN Business Club in KL. However, Zeti said that if oil price drop to a certain threshold level, government revenue and development expenditure will be going to be affected. In fact, she said investment in the petroleum industry will be cut back, and when the price increase, that the supply would be contained because the investment did not take place. So there's some economic term there, but what she meant is investment in the petroleum industry will somehow lowered this year, but when the oil price increase, which she's quite optimistic on it, that the supply would be contained and the investment in fact did not take place. So in a way that Zeti, it seems that the government is well prepared in terms of foreseeing how the outcome of the volatile oil prices would affect the Malaysia's economy, and she's quite optimistic that it will not affect as much. So on the other research think tank point of view, they also agree that the recent fall in global oil prices will not affect Malaysia's income, although it might affect the global demand of oil by higher discretionary income. But it will also then feed into export demands. Malaysia is the only net oil exporter in the region. Its oil imports have risen relative to exports over the last 3 years. The CIMB Research is a think tank, is a Malaysian think tank, saying that they acknowledge Malaysia's government oil revenue would be affected by weaker global oil prices like any other oil and gas company, but it will not be a real risk, just like they agree with ZETI, to the fiscal deficit target of 3%. So in fact, with an expanded revenue base, the implementation of GST, and in April this year, and the oil revenue's contribution to total revenue is projected to fall below 30%, regardless of oil prices. In fact, it looks like Malaysia will not be affected by oil prices. The same with Southeast Asia. That's the majority point of view by the government and also think tanks. In fact, it's stated that if the transition to a market-based fuel mechanism proceeds next year, the oil prices lower, then consumers should benefit from high disposable incomes, assuming a complete pass-through of lower prices. So it's pro the idea of trying to leave the market to lead the way in terms of oil prices or in terms of other economic activities and also economic prices. So in a way, on the upside, they also see that the Malaysian government subsidy saving can either be used to bring down the fiscal deficits or be channeled towards productive spending. So it seems like what a lot of Malaysians economists and also thinkers are analysts are quite positive about Malaysia not being affected by the oil price and not being affected by being the organizer for this year's ASEAN Economic Community. So moving along, what the Malaysian International Trade and Industry, Datuk Mustafa Muhammad said, he actually see the trade sector may actually face challenging prospect this year. On the other hand, he seems that the Malaysian the MITI, or the Malaysia International Trade and Industry, is actually working on the trade forecast figures, and what they are seeing is the impact of current oil prices, economy, balance of payment, fiscal deficit, as well as GST would somehow affect Malaysia a lot. That's quite a view there. And 2015 is a challenging year, but he doesn't want to preempt as more detailed analysis need to be done. And he said that the ministry would revisit its forecast figure because they were quite optimistic on the figure when they forecasted it last year. They are revisiting it on especially on the foreign direct investment and also export value for electrical and electronic products in view of the current ringgit's performance, which is doing really, really bad. And he said that Malaysia's export in November 2014 rose by 2.1% to 63.73 billion ringgit, the highest ever recorded in November last year. The trade surpluses of 11.13 billion registered during the month was the highest value since 2011, 4 years ago. So in a way, what he's saying is he's trying to opening out Malaysia or ASEAN towards a more regional focus rather than national focus. He's trying to encourage more ASEAN counterparts to work together to ensure that the impact of global oil prices and global external threats would be at a very minimal, and strengthening the Southeast Asian economy based on the ASEAN Economic Community Blueprint. We will take a short break. We will discuss more about the oil prices and about more on other countries within Southeast Asia, how they are coping with the global oil price.
Monday Morning Matters. Perspectives from Southeast Asia.
Hey, this is Arlene. You're back again with perspectives from Southeast Asia at our Monday Morning Matters. So today we are going to talk about the plunging oil prices and how it is impacting ASEAN economic community. As we discussed earlier, a lot of the Malaysian economies are quite optimistic about it, although there are some that is not so optimistic, especially with the falling Malaysian ringgit value, as well as how it would impact the Malaysian economy, considering that 2015 is a huge deal. It's a big deal to Malaysia being the chairman for the ASEAN summit, as well as the realization of the ASEAN economic community. And I personally, if you ask my personal opinion, I'm a bit of a 50-50. On one hand, Malaysia is trying its best to ensure that ASEAN economic community is something that of a reality, but on another hand, are we doing enough, and are we capable of doing enough? Some ministers within Malaysia are saying that it's a process, it's not a destiny. So a process meaning that it might be a gradual change towards ASEAN economic community. It will not be something like EU, where it was actually a big deal when it changed towards the European Union. So when it comes to ASEAN nations, a lot of the ASEAN countries, for example, Cambodia, Laos and all, they are really looking forward. They are making ASEAN economic community a top priority. These countries are economically behind, but they are catching up definitely very soon, and they are seeing the potential of the AEC to somehow bringing benefits towards these impoverished countries. And in fact, even countries like Singapore and Indonesia, they see ASEAN could potentially bring some benefits towards Southeast Asians, especially with the focus of, for example, setting up the regional integration of investing nearly $500 million in ASEAN infrastructure, such as building roads, railways, and other projects without direct foreign assistance. So in a way, definitely this is a top priority for any country, in a way, to build ASEAN economic community a realization. But on the other hand, about Malaysia, as much as Malaysia is looking optimistic how the oil price would not really affect Malaysia, but it can also really affect certain industry within Malaysia, such as the property market. Apparently the sliding oil prices, which has weakened ringgit and spooked equity investors, is now feared to reverberate to the property sector, which saw investors shying away from property stocks and underweighting the sector. The sector of property and investment has set of its own challenges, such as tighter financing, high property prices, and oversupply in certain segments, such as high-end condominiums in Iskandar, Malaysia. Nevertheless, some analysts, such as the Public Bank Investment, believe that the property prices will not correct drastically in the near term, despite the lower volume. It overweights stance is predicted on property prices holding well, which supported by ample liquidity, high input costs due to compliance and land costs, low interest environment, and strong secular positive. A lot of the young demographics and improved connectivity for mass rapid transits, LRT and other high-speed rail spending. So it seems like the stakeholder and are quite optimistic about the property prices, even though some are not happy about how the oil price would affect the property market in Malaysia. Other than property market, trouble is also brewing in Malaysia because how it is affecting Malaysian ringgit tremendously, and it is affecting Malaysians overseas, especially Malaysian students studying overseas. Ringgit falling from 2.9 ringgit to 3.5 per US dollar, and Malaysian ringgit has skidded heftily by 7.95% against US dollars since the second half of 2014. On a year-to-date basis, Malaysian ringgit was the second worst performing currency among its peers in ASEAN region, just behind the Japanese yen. And the Bank of Japan continue efforts in expanding the nation's monetary base and sending signal on further stimulus plans. The Japanese topped the list as the worst performing currency in Asia, and Malaysia is just right behind Japan. And this is all due to the violent swing of the crude oil prices. A weakening ringgit could diminish investors' real returns and the trust towards the Malaysian ringgit as well. Reduction and also it will be resulting in a reduction of real purchasing power. In fact, some analysts are quite negative about how Malaysia would perform this year in terms of Malaysia's economic outlook. For example, it will risk appetite of foreign investments to go down the drain, lower the trust of investors, foreign investors, especially towards pulling out massive funds of theirs from Malaysia and reinvest in other Southeast Asian countries, perhaps. And capital flight out from Malaysia hastened with the gradual strengthening of US economy, and the deteriorating outlook regarding on Malaysia's growth would in fact impact Malaysia a lot. In fact, what we are seeing here, investors have been offloading Malaysia's equity in the open market over the past 5 weeks, with the latest week registering the fourth highest withdrawal of the 840 million in a week. There also seems to be high yields of Malaysia's government securities. While Malaysia's government has been taking measures to reduce its reliance on oil throughout the past few years, oil-related revenue remains to be a significant contribution to Malaysia. As we all know, Petronas is somehow the piggy bank of this country. Whenever we need money, we will go to the piggy bank, which is Petronas. And approximately 32% of our national budget comes from oil-related revenues. So with oil-related revenues making a substantial portion of the government's coffer, the persistent drop in oil prices has really compounded the risk that Malaysia might not be able to achieve its 2015 fiscal deficit target of -3%. The recent sharp decline in current account surplus have also spurred investors into widespread fear that Malaysia might fall into a twin deficit situation. As a result, market, especially the Malaysian government securities segment, have started to factor in expectation that Malaysia might not be able to achieve its fiscal objective as outlined in the last budget tabling last year in 2014. So a lot of people are definitely putting a lot of concern, and a lot of the concern also is in the banking system. As we all know, Malaysian banking, or Maybank, has been one of the worst performing in the banking sector. In last year, in common with other Malaysian banks, it has experienced EPS downgrades driven by a weaker than expected domestic NIM, slow capital market activities, and a deterioration in both NIM and credit quality at its Indonesian subsidiary BII, Bank of Indonesia. In addition, it has gone from being one of the highest rated ASEAN banks relative to its history to being one of the lowest rated. What are you doing, Maybank? The slide in the oil price since September 14 has particularly hurt its rating. In fact, Malaysia is seen as being most negatively impacted by the falling oil price. So the banking system in Malaysia are also being affected quite extensively. It's not just in the property market or in the Malaysian ringgit or in the FDI sector. So, but interestingly, Malaysia, when it comes to issues in Malaysia, it's not just the oil. There are some analysts saying that Malaysia's economic outlook is not seeing well, and they are questioning whether we are able to move forward in terms of our goal in ASEAN and the ASEAN economic community. It's also because of other reasons, which is not necessarily related to oil. And there are people who are saying that the sharp currency depreciation or Malaysian ringgit fallout and the introduction of GST will be dragging 2015 gross domestic product growth below 5% from an estimated 5.8% last year. In fact, the dramatic decline in crude oil prices is also playing a role for emerging Asia's only major energy exporting economy. 54% plunge over the past 6 months has noticeably hurt Malaysia, where petroleum products and liquefied natural gas account for 14% of exports. Barclays recently reduced its 2015 GDP forecast to 4.5% to 5.5% following a similar, to 4.5% from 5.5% following a similar downgrade by the World Bank to 4.7%, both well below the government's 5.5 to 6% growth forecast in 2015. What is seeing this, according to one of the bank, forecasted that the trade balance could potentially, Malaysian's trade balance, which is having a trade surplus at a 3-year high but failed to improve the country's economic outlook, could potentially be an Achilles heel in 2015 due to pressure from lower oil prices. Weakening Malaysian ringgit against the US dollar, as I mentioned earlier, would add more pressure to the Malaysian ringgit, striking the extent of 3.6 ringgit, and not far from 3.7, a level not since the ASEAN financial crisis in 1997. So a lot of the international economies are actually not optimistic at all in terms of the short-term relief, in terms of the long-term of this year's Malaysia's economic outlook. In fact, they are hoping for relief in the short term. Well, it seems like there's a lot of work for Prime Minister Razak, especially with a lot of things that are happening this year, including the introduction of the GST. And a lot of the internal issues, such as the quasi-sovereign wealth fund, One Malaysia Development, which has missed a payment of 556 million US dollar loaned due to the end of December for the second time, added to Malaysia's current woes. So, in a way that a lot of the internal politics and internal economic disadvantage has outseeded the oil price problem that oil price challenges that Malaysia have. So Malaysia, in brief, is definitely not having a good time. In fact, if you compare Malaysia with other countries within Southeast Asia, Malaysia is actually the only country that is having a fiscal deficit of 0.2% compared to other Southeast Asian major powers. For example, the Philippines are having a better GDP at 2.1%. The same with Indonesia, Singapore, and Thailand. In fact, Thailand is actually receiving the most benefit in terms of GDP, in terms of when it comes to the oil trade balance. We will take a short break. When we return, we will analyze more how other countries in Southeast Asia performs or will fare with the oil prices affecting the global economy.
Monday Morning Matters. Perspectives from Southeast Asia.
Hey, this is Arlene and we are back again with our Monday Morning Matters, where we analyze news and perspectives from Southeast Asia. So today we are going to talk about, or we have been discussing about the plunging oil prices all over the world and how it is affecting Southeast Asia as a whole and ASEAN economic community as a whole. As we have analyzed earlier, how Malaysia has been at the forefront in terms of being one of the biggest victims in Southeast Asia for the oil price collapse. But not to forget our little neighbor next door, which is Brunei, also being one of a substantial producer and exporter of crude oil and natural gas for Asia, also, and relies on hydrocarbon revenues for nearly 2/3 of its GDP. According to the U.S. Energy Information Administration, has since have seen being nosediving since the end of last year for Brunei, and it was trading at 5.5-year lows and just above $50 per barrel in early January. There is likely to be more pain in store for 2015 for Brunei Darussalam. Nevertheless, the IMF noted that in July, the main risk to the economy stemmed from energy prices, but Brunei appears well cushioned by substantial fiscal buffers thanks to prudent policy making, which has provided large fiscal and current account surpluses. And in fact, the Sultan of Brunei is making strides to diversify its economy as part of Brunei's Vision 2035 strategy, which aims to reduce its reliance on oil and gas and increase private sector's employment. So in a way, we are seeing here, even Brunei are definitely making the most in terms of significant change of its focus on the AEC, where it's having a number of regional and international trade agreements for 2015. And according to Tim Gardner, Global Head of Institutional Client Group of AXA Investment Managers. The AEC single market will help attract more investors through the introduction of a common set of rules and will alleviate any political risk, hopefully so. Another trade agreement in the House is the RCEP and of course the TPPA, but of course for Brunei they are only signing for the RCEP. So it seems, but it also at the same time, the Sultan Hassan Al Bolkiah said in November that good momentums while building towards the conclusion of the TPPA. So let's just see how Brunei would fare in terms of the international or the global market. But definitely for Brunei, perhaps even with the low crude oil prices, is already escaping or making an escape plan for itself to ensure that whatever volatile prices that is happening right now for the oil sector, it will not affect how Brunei would put itself in terms of its economic direction. Talking about how Southeast Asia are benefiting from the falling oil prices, with oil at its lowest price since more than 5 years ago. Governments in countries such as India and Indonesia can spend money on much needed infrastructure and other growth projects without stoking inflation. So the falling crude oil prices also give countries like China a boost, allowing its central bank and other in the region to ease rates even as recovering US looks to do the reverse. I give example of how the domestic gross products of some Southeast Asian country like Thailand is at 0.45%, Philippines at 0.3%, Singapore at 0.15% growth, while Malaysia unfortunately is at 0.2% negative growth. In fact, Indonesia even is at 0.1% growth, which is quite commendable, seeing where Jokowi wants to have a 0.7% growth is definitely on the right path. When it comes to inflation, a lot of the countries within Southeast Asia are definitely having lesser significant inflation rates. Perhaps the only ones that are facing a high inflation rates would be the Philippines at negative 0.45 and Indonesia negative 0.4. And the current account balance, what we are seeing among all the Southeast Asian countries, Philippines is doing the best at 0.8% surpluses, while Malaysia is doing at a very bad, the only one at the negative of 0.1% account balance deficit. So it shows that how the oil prices is definitely making Southeast Asia a booming focus for foreign direct investment, save for Malaysia. Unfortunately, Malaysia is not doing well at all. In fact, according to World Bank, the falling oil prices is a chance for governments in Southeast Asia to cut oil subsidies, and we have seen how Joko Widodo has done so. The same with Malaysian government has done so in terms of cutting oil prices. It is definitely a good move by governments to cut oil prices during when oil prices to cut oil subsidy when the oil prices is very low. So in fact, for countries within Southeast Asia, when it comes to policy reform of its economic policy, this would be the best time to do so. So listen to out there Najib's administration as well as Indonesia's Joko Widodo administration. So, but on the other hand, for Indonesia, lower oil price is actually a double-edged sword, according to the Finance Minister Bambang Brojonegoro. He said that even though it will be good for Indonesia as it can reduce inflation and it will be economically advantaged in terms of its investment and spending, but at the same time, it might not be good for Indonesia, as we all know Indonesia is also an oil exporter, although not as significant as Malaysia. It would definitely hurt the newly operating shale oil producers in the world's largest economy, which is Indonesia. And they are actually quite concerned with the oil price war between Saudi Arabia and the US, how it is deliberately allowing oil prices to decline, and how this will actually affect net oil producers and exporters. Malaysia is definitely hurting very badly from it. Indonesia as well is a double-edged sword. So in a way that Indonesia's is actually winning and losing at the same time, if you are saying in that sense. What they are saying is they expect the reduced likelihood of a budget blowout from fuel subsidy to attract confidence-sensitive capital and drive up government bond prices. Other areas, other analysis of the oil prices, how it is affecting ASEAN. Apparently, in Singapore, actually the outlook is pretty positive. In fact, to tap to the growth prospect, what it's saying is the launch of the Templeton ASEAN Fund and its planning to set up more equity funds focused on Asia and ASEAN in particular. So it seems like a lot of the investors are definitely being attracted to Singapore as it is performing quite well with the oil price plunging. And it is, and a lot of investors are also looking at the ASEAN economic community being one of a key point in terms of trying to spur growth as well as to making more investment in this region. So in conclusion, seeing how the oil prices has affected all the different countries within Southeast Asia, especially key countries, what we can conclude here is it is definitely making Southeast Asia a very attractive region for investors to invest, making a single market of the ASEAN economic community a realization, nevertheless. A good realization. But on the other hand, Malaysia being the chairperson of this year's ASEAN Summit, Malaysia is not probably the only country not performing well at all in Southeast Asia. It will definitely hamper, Malaysia would definitely be the Achilles heel for the ASEAN economic community and for ASEAN itself. So more discussion is needed among ASEAN leaders to address this issue as an ASEAN issue rather than just a Malaysian issue if it's serious at revamping ASEAN as a single market. That's all for our Monday Morning Matters, where we give our perspective on Southeast Asia.